In terms of speaking about the markets, the economy, this crazy world we all live in, and how to interpolate it, build the appropriate insights, the best thing you can do is just tell yourself one thing. It's a lot easier than people give it credit for. And I say that because there's far too much noise, too much confusion. Everybody's looking for an angle. The only angle there is preparation. And I say that to all of you as you're heading into your throes of your college career, and as you're coming out, you're going into internships, and you are hopefully heading into the job market. Take that with you. The art of preparation is being prepared before you have to be. And if you take that into the financial markets and the economies and geopolitical risk and trading and research and everything that you go into, whether it's the financial markets, whether it's sports, movies, entertainment, education, et cetera, you'll quickly see that there's far too much noise out there in whatever industry we're talking about. So today, I'm going to introduce a couple of new terms to all of you, both of which are very unconventional. You're not going to read them in a textbook. You won't probably read them in the news. Hopefully you won't. But if you read one of our research reports in the upcoming weeks, you'll see it in there. So I want to touch a little bit on that unconventional term. And I think it's really important to learn new unconventional terms and marry that with traditional methods as an anchor. Business cycles change every 5, 6, 7 years. And you guys are seeing this unfold through your eyes right now. And we're going to touch also on some traditional business cycle dynamics. I won't bore you. Hopefully I won't bore you. You might think so, but that's not my attempt. I want to try to take you through what's going on around the world, some things that are a little bit exaggerated, frankly, others that are not being paid attention to enough. We're going to take you through some positive developments that are also pushed aside that give us a lot of support for this bull cycle that we think is just about ready to resume itself again. And last but not least, we'll get into portfolio strategy, long-term themes, and some big collateral portfolio strategy implications that are coming down the pike in the next year. So I appreciate everybody canceling class tomorrow for me. We'll be here overnight into the wee hours of the morning. Just kidding. So we'll start with the unconventional methods. You're going to hear a term or at least read about it, and we'll make sure that everybody gets a report. It's called the bullwhip. And if you can envision a bullwhip, I first like to talk about exactly what that is. Envision a garden hose in the backyard that has a kink in it about 3/4 of the way from the actual spigot all the way to the nozzle. Now that kink is allowing water to flow, but then it stops, and there's a frustrating element to it. Most of us don't want to go and undo the kink right away, so we basically wave a snapback of the hose to undo the kink. When that happens and the kink unfolds and it opens up again, the hose generally goes forward. It's the same thing with a bullwhip. If you are a matador, or if you are in Spain in the running of the bulls, or what have you, or in the ring, it is a snapback from a drawback, but the snapback is a little bit bigger than what the drawback was. And we're going through that now. We're going to have our fourth bullwhip effect in this early cycle. And the reason why there's multiple bullwhips, generally speaking, you don't get this, but it's because there's significant portfolio repositioning going on between short-term investors, i.e. hedge funds, traders, systematic investors that use models and algorithms, and less about qualitative dynamics, and the long-term investor, the pension fund, the insurance company, the retirement system, the asset manager or the fund manager. And they're trying to reposition heading into a whole new segment of the business cycle. And the market cycle usually discounts the business cycle. There's varying degrees to what the discount is. Sometimes it's 6 months, sometimes it's earlier. But in the business cycle dynamics we're working off of right now, you still have $11 trillion in support. Now, to put that into perspective, 11 trillion on a base of 22 trillion. The US economy is 22 trillion strong at its peak. That's 50% of liquidity-based programs by the Federal Reserve. In other words, just releasing reserves into the system for use in a number of things. Corporations use it to pay down debt. They use it for CapEx, capital expenditures. They use it for investing in the future. Sometimes they buy back stock, whatever it is. The cost of capital is very low. Investors use it to exaggerate a particular position they have. That's called leverage. The portfolio manager will use it to hedge. The basic premise here is don't get too confused as to how much liquidity is out there. Let's just say we still have emergency liquidity facilities in place, but yet the economy, despite the Delta variant, is still growing at its highest level nominally since 1983. So you've got a nominal growth of double digits in the US. You've got a pullback in real growth simply because of supply chain disruptions. You've got emergency measures still in place by the Federal Reserve talking about removing them. And you have fiscal stimulus to the tune of $5.5 trillion and potentially more. So as you can see, investors are flush with cash. The household is flush with cash, even though there's still 8.5 million jobs unfulfilled in the United States. You all see it when you go to restaurants. You might even see it on campus. Tough to get labor supply. A lot of reasons for that. That is about to fade. And it's specifically going to fade more or less as we head towards 2022. But there's 8.5 million unfulfilled jobs, and there's less people to fill them. So when you go through, there's about a 2.5 million gap in terms of job openings versus the available labor supply. So of course, labor costs are going to go up, and you have supply chain disruptions. So when you talk about the business cycle, you're going to hear a lot about this in class, particularly in microeconomics. Supply demand curves mean everything. That's how prices are adjusted. And there's price elasticity, inelasticity, and I won't bore you with all that because you get that daily in class. But the way to think about it is if you have a demand shock or a supply shock. Now, what we're going through right now is a supply shock. When you go through business cycles with supply shock, that's where prices go up. That's where you can have elevated inflation. And that's generally where you have to match real-time adjustments in the supply, whether it's energy, which you're seeing right now, very difficult in Europe and Asia, less difficult in the United States. If it's goods in manufacturing, generally we call it kitting. Unconventional term number 2 after the bullwhip. It's called kitting. All kitting means, K-I-T-T-I-N-G, is you're building a kit of different levels of components. And when you can't build that kit because one component can't get accessed and there's a disruption in that supply, it doesn't matter what the 5 or 6 other components, you can't build a new car. And that's what's going on. So the used car market becomes more in demand and used car prices go up. That feeds into inflation. Same thing with housing. You have apartments in need more than ever before because of the size of the millennial cohort. So all these things are feeding through at a time where all the stimulus has yet to fill its full effect into the economy. So we're going to have a supply shock stay with us well into 22, probably into 2023. And that is not even considering what's going on with Delta variant or whatever new variant that may come down the pike. So you've got aggregate demand that far outpaces supply. You've got shortages everywhere. So this business cycle is not late cycle. There's a lot of people who believe it's late cycle just because inflation's picking up and growth is running well ahead of above average levels. But in order for us to shift fully into late cycle, you have to have the Fed raise rates and fully go hawkish versus still their dovish tendencies. I know they're switching, but we're still late mid-cycle. We're not early late cycle yet. So there's a lot of confusing dynamics in the economy that are forcing, frankly, many economists and people that have been studying the global, if not the US economy and markets for a better part of 40, 50 years, to not admit that they're getting confused, but they're getting confused. I won't go all the way to say that this is modern monetary theory that you may have read about. It's there. I would simply say modern monetary theory is adjusting for the cycle we're in now, which is high debt, supply of dollars increasing around the world, and a supply chain that is increasingly coming home. How do you deal with that? Well, you have to subsidize the debt. You have to monetize the debt. And if you're the Federal Reserve, you know this. You can't afford to have interest cost of the high debt that continues to grow each day, even outside of a pandemic. Can't afford those interest costs to go up to a level that is above the cost of capital. Otherwise, the economy goes into recession and liability pay downs become even more difficult. Those we have seen in cycles past. In fact, in 2018, in the fourth quarter, the Federal Reserve tightened too quickly. They tapered. And then they immediately moved to raising short-term interest rates at a time when inflation wasn't an issue. In fact, inflation was below their 2% target as measured by the personal consumption expenditure. The point here is they realized they got ahead of the curve. They factored in that inflation was going to go and come back to bite us. That was at a time when real growth was 1.5% and nominal growth was 4%. Today, nominal growth is going to hit 10, 11%, and real growth is going to be somewhere around 5. So as you can see, they're saying inflation is transitory. So they're saying the exact opposite of what they said back then. So our view, my view, is one that inflation stays higher for longer. The Federal Reserve is beginning to understand that, and they're going to use words, and then they're going to pull back on their bond purchases. In other words, take reserves out of the system, or at least take money out of the system and let reserves pile up in the banking system. That lowers the lending velocity, and that traditionally lowers the level of inflation. This time around, very different. There's going to be a little bit of that before they ultimately bump up short-term interest rates, which is most likely late 22. If they fast track that, the markets will not like it. They've said late 22, early 23 at the earliest. If they pull that forward and they shock the markets, that's where the yield curve will flatten, probably invert, and then the proverbial questions about a recession will come. Don't think you're going to see that this time around. There's far, far too much aggregate demand out there in the system, and this is still a supply shock, very different than a demand shock. So point number one, bullwhip market, a bullwhip type of cycle where it snaps back faster than what the snap down was. And that's both the market drawdown, this little drawdown we're going through now, as well as the real growth drawdown because of things like China's debt, as well as some of the supply chain shortages. Second unconventional term we talked about is kitting. Think about that, K-I-T-T-I-N-G, in terms of access to components that cannot change in the near term. That takes a long lead time to work through. It's happening in energy. It's happening in semiconductors. It's happening in most what they call original equipment manufacturers like autos, et cetera. If you can't get the parts and the components to build the kit, ultimately you have to either shut down factories, shut down lines, and ultimately that feeds into a slower growth rate. But that demand doesn't go away. That's the important part. The demand is still there, and there's still high pent-up demand. So let me switch a little bit into just the wall of worry that's out there. And obviously there'll be a lot of questions about this. Every year there's a wall of worry. This year, it was built at the beginning of the year, like we all do in our year ahead pieces. In the middle of the year, it was added to, and here we are in the third quarter heading, well, in the throes of the early part of the fourth quarter, it's now building even higher. So we like to say that this is a ladder. If you guys have used new ladders recently, those ladders look small, and then you can extend them, and then you can extend them further, and then extend them further than that. That's what the ladder is right now, the ladder of worries around the world. And what at the top of the ladder are gray clouds. So climb the ladder, you're up in the gray clouds right now. The way to dissipate the clouds is to make things more transparent, allow time to unfold, and then or lower the ladder. So there's two things that you will likely see in the coming months. The first thing is we'll get much greater clarity on concern number one, which is China's debt and property development problem. Obviously, Evergrande being the second largest property developer in China, is under significant pressure right now for a variety of reasons that have been built up over years and years and years and years, and it has been an issue until it ultimately needs to be unwound. The likely resolution of China's Evergrande situation will be asset sales, number one. We saw that this morning. They're going to sell down some bank assets they have to help pay down or at least make the interest payments on their debt. They have $300 billion in debt. A lot of people were suggesting that this is the world's Lehman moment. It's not. For any of us who have lived through the Lehman moment and the AIG moment and the credit crisis, this is a very, very small, thin slice of what we all went through some 13 years ago. China's Evergrande debt problem is more of a growth problem for the economy of China, which will get exported around the world. This is less of about a financial systemic risk problem. As it relates to overall their debt, again, asset sales, pay downs, they will likely send a signal to investors about haircuts on their bonds. As everyone has seen recently, China is moving towards what they call common prosperity. and that's about the protection of their citizens. And there's a very, very big reason for it that very few people talk about, but it's about their constant concern about the retirement plight of some 500-600 million citizens that are still out in the farms that have yet to get jobs and come into the cities. And they need to build a 20-year plan. And one of those 20-year plans is now finally common prosperity. They've switched from one belt, one road. And they're coming after and regulating a whole bunch of the wealth that's been built up in various sectors. That's not going away. It's going to chip away at that over the coming few years. The end result of this is they're going to allow some of this debt pay down to most likely not be paid down and harm some of the bondholders, much of which are contained within China, and then secondarily a little bit in Europe, particularly through the French banks, and then very, very, very minor in the United States. So it's more of a growth issue, not a financial systemic issue, but watch asset sales, watch a controlled restructuring, watch some monetization of that debt led by the Chinese government, which ultimately controls the banking system. That's worry number one. Worry number two is minor, actually. It's tax hikes. We've seen constant transparency around this in the United States. The worry is just about getting it over with, and it's less about what it's going to be. What it's going to be is a lot less than what was originally announced about a year ago, and then ultimately picked up through the summer. And then now, as we have 1 quarter to go, and most likely we'll get more clarity in the next month, but it's more than likely going to be at the lower end of all tax hikes than what was originally mentioned. So that was more of a minor part of the latter. The third area has to do with the debt ceiling, the here and now, and funding the government. It's more about short-term. I wouldn't call it noise because it's very important and could lead, if they do illogical things, to something that we all don't want to see, which is yet again the downgrade of U.S. debt, which happened back in 2012. That would obviously upset markets and upset them very aggressively. We think ultimately logic in some degree prevails. You'll see the debt ceiling raised. It's not likely to be tied to the infrastructure bill. You saw some of that news out over the last couple of days, and you'll likely see the $3.5 trillion chiseled down to $2 trillion. The $1 trillion infrastructure bill goes through. Perhaps the social bill gets chiseled down to $2 trillion, and the debt ceiling raised and ultimately pushed out funding the government by October 18th, which is what Treasury Secretary Janet Yellen has put a line in the sand. But until between now and the next 17 days, down to the 12th hour, it will likely go. Markets are unnerved by it right now, and you're starting to see some of the short-term fixed income markets adjust for that. Again, big noise, an issue, but logic should prevail, or at least to some degree, and debt ceiling raised. No overall default, and certainly if the government is shut down, perhaps it's for a day or two. Another worry, supply chain shortages, and that goes as far as labor, energy, semiconductors, and a variety of different components, and some of the base metals. Overall, very difficult to unclog that pipe, unkink that hose. It's going to happen over the next year and a half or so because aggregate demand is going to still remain high. And companies started to position themselves for a much slower growth rate because of the Delta variant, and there's been many head fakes on this. Last year, they thought as though that the reopening wouldn't go as smoothly as much of it did, and they also weren't positioned for the amount of goods purchases that happened, and whether it's online or curbside pickup or what have you, all around the globe. And they weren't certainly positioned for all the stimulus that was put in place that accelerated a lot of those goods purchases. So they're still picking up steam. They're still trying to come to grips with this new business cycle dynamics. And at the same time, prices are now being raised. So they're pulling back. At some point, gas prices, energy prices rise to a level where demand destruction starts. That's probably at the $100 level on West Texas Intermediate, which is another $25 or $30 away from current levels. So we've got a ways to go on that. But gas shortages in Europe is a major problem. They have to turn to Russia for it, which is not a good proposition. And China has picked up a good portion of European gas over the last few years through long-term contracts, which is why they have to go north or west a little bit towards Russia to get it. In the United States, we have an overabundance of gas. The problem there is once there was a signal that the XL pipeline was not going through, that was a signal that capital expenditures were going to get pulled back by the large integrateds and obviously the greener technologies that are being invested in take a lot longer than people originally expected, including wind and solar, to pick up for where gas left off. And even though we have an abundance of it, to be able to use it more efficiently and effectively and get it into the manufacturing processes takes time, particularly when you haven't invested in it in 2.5 years. So that should likely remain. There's a slew of other ones people are talking about in the markets. Some of the well-known shorter-term strategists are talking about peak everything, peak profits, peak revenues, peak growth, peak accommodation. We don't think it works that way. It works over in spades. And the way to test that is to look at financial conditions, look at the dollar, what's happening there, look at the yield curve. Is it steepening or flattening? Is it inverting? Look at credit spreads, look at bank funding levels, and look at the risky asset currencies out there. They usually give us much greater signals than most of the talking heads will emit on some of the business channels. So we don't think it's peak everything yet. We have another third opening coming. The Delta variant is fading. You guys likely see that just as well as we do. The Northeast is still coming to grips with the end of the Delta wave. We're on the back half of that. Usually these Delta waves have, on average, lasted 45 days. We're about 30 days into the peak wave in the Delta variant. So think between now and then getting into something like the latter part of October, perhaps it leaks into November in terms of peak wave for the Delta variant. And you'll likely see a third full reopening, which is travel, leisure, and entertainment costs. Spending goes back up where goods spending left off. Some of the positive catalysts, switching from the big worries in the ladder up in the gray clouds that should dissipate in the coming months. The funny thing about markets is there's a new worry every day, and it feeds on itself, particularly when you have programmatic trading and you have more machine-led trading today than ever before. I think 78% of all volume in the markets is machine-led today. It was probably 1/4 10 years ago. When you get that, one small adjustment to any financial metric can upset a model and then force portfolio repositioning. That's more of a short-term, week-to-week, day-to-day situation, but it can gather momentum, and that's where you get a 5% pullback turns into a 10% correction. When fundamentals are still very favorable, still heading higher, still not an issue as it relates to conclusions coming out of the corporate sector relative to expectations. Fundamentals ultimately win out. So fundamental number one, that is a positive catalyst to close this year and most of next year, is profits. Company estimate revisions are still going up in every region of the world, even in supply chain distortion world. So consider this: a company doesn't care ultimately how profits generally are rising. They would like to have some pricing power where sales goes up because of pricing power and volume. They would like to have expense management through productivity or CapEx, spending on innovative software programs or what have you. They would like to keep labor costs flat, so you get an expenses flat, revenues going up, and profits. In other words, operating leverage is going up, and it feeds right to the bottom line. That's what a company would like. What's happening now is exactly that. You have some pricing power going on. You've got volume going up. Operating leverage is pretty exciting or attractive, and profits are going up and surprising most of Wall Street each quarter, each half year, each year. So we think you're going to see somewhere, consensus is about $215 for the S&P. We think there's risk to 225 to the upside. Next year, there's risk of 240, 250. Maybe you get a haircut of 5% because of corporate taxes going up, so it takes it back down. But generally speaking, we think the consensus is still trying to climb that profit optimism, and they're still being muddied by this ladder of worries. So we think consensus is off by 10 to 15 bucks, and you put a multiple on that of 20 times in the S&P, that's 200 to 300 points that they're off on, in our opinion, on the S&P. So I would not be surprised that we go to new highs between now and the end of the year. I would use weakness in the markets to add to certain parts that are going to benefit over the next year, not just the next few months. And we'll touch on that in just one moment. The second part of the positive surprise is literally going to be what's happening overseas. China's growth will likely not be as bad as people expect, and that's because they are adding 100 to 120 billion in overnight liquidity. Number one, to protect against the Evergrande situation, and two, they realize that they have gone into sectors that have produced the highest growth. So expect them to add stimulus while they're slowing down, but not slow down as much as everyone expects. And that will keep the growth curve nominally around the world much higher than what consensus believes. And then last but not least, I think this goes without saying, though, even though inflation and yields are heading higher and likely to stay stickier for longer, we still have negative real interest rates. Think about that. Negative real interest rates is a powerful reflationary force. It allows the cost of capital to stay low, the return on capital to have a higher delta, no pun intended, than what traditionally happens. And that means you have a comfort level of taking risk. Plus, corporations are flush with cash. Investors have at least 3.5 trillion excess savings. So even if prices go up, they're more than willing to pay that price hike, at least while they have excess savings, and particularly while there's negative real interest rates. That's the backdrop right now. That's the backdrop we'll be in for the coming months. Now, when does it change? It changes when real interest rates go from negative to positive, and that's when the Federal Reserve and the economy exhibit the fact, two things. The Fed's going to get more hawkish. That's more than likely going to start in November, taper in November. They will do it slowly. The curve should adjust for that. The 3-month rate, 5-year rate, most susceptible to that, even the 2-year. They'll start to rise a little bit. The curve will likely steepen because the economy will reaccelerate due to the third opening. And then the areas that are most exposed to rising yields should do well. The ones that are likely to be harmed are the longer duration, very growth, big story, little profit companies. So the way that we envision portfolios being repositioned in the coming weeks, in the coming months, to get ready for two big collateral events. The first one is rising yields, and the second one is expectations for inflation. As those two things go higher, then the repositioning game goes on, both with systematic traders, short-term traders, and long-term investors. We expect the value part of the S&P, the value part of equities, to be more exposed. In other words, people to use profits in the growth side to buy value. They've done it a few times this year, but it never really lasted. We expect it to last this time around. The second is economic sensitives relative to defensives. The third is still going to be the areas that produce high free cash flow, will pay you a dividend above the 10-year yield, so consider 2% dividend or better, and that will be an anchor in a portfolio. The U.S. should still be the bias by global fund managers simply because the rising input costs, the Delta wave overseas, the less penetration of vaccination rates, et cetera, keeps growth below their potential. And then last but not least, in fixed income, it's the credit side, stay high quality, stay shorter term, longer duration will be harmed by rising yields. Real estate, apartments, storage REITs, warehouse REITs, server REITs, those are the areas in the defensive side that are bond proxies in the equity market that should still do well because they're exhibiting high free cash flow. And I'll just end on some long-term themes. Long-term themes are still this. Number one is cybersecurity. It's still in its infancy, despite the fact that we hear about it every day. As big data, as the digital economy continues to grow, which is still only 1/3 of the overall economy, 6.5 trillion or so. That 6.5 trillion on a 22 trillion base is going to grow to 50% within 5 years. Big data, obviously the Internet of Things, the protection of data itself, cybersecurity is number one in my opinion. Number two is in all of the above energy sources: wind, solar, green technologies, hybrids, and still conventional hydrocarbon. Number three is going to be life sciences, the intersection between innovation, the acceleration of mathematics and science and big data together to produce things like messenger RNA vaccinations and therapeutics that simply used to take well over a couple of decades to produce and now can be done in a matter of months, if not just a year. Fourth is one that you hear a lot about, is robotics. It's taking over. There's a big retailer online that just released one recently. It's kind of funny. Take a look at it. It might be roaming your home very soon. But more importantly, you're going to see it behind the McDonald's cash register. You're going to see it flipping burgers. You're going to see it in Dunkin' Donuts. You're going to see it all over the place. And it's not going to take away labor. it's going to close the labor supply gap. And that keeps expense management, number one, in the forefront, and that keeps profits heading higher, in my opinion. It doesn't necessarily take away jobs. And then last but not least, the acceleration of innovation as it relates to all sectors. And that comes down to particularly the use within the manufacturing segment. If the supply chain is an issue today, and we need to work and chip away at it, supply chains are coming back to the United States. The use of not just robotics, but manufacturing as it relates to building new technological enterprises and powerhouses is here. That is going to require significant capital expenditures. And thankfully, the tech sector is flush with cash. So here's what I would think about in the next few years. On weakness, we're going to be adding to value. We're going to be adding to economic sensitives through financials, energy, and materials from a sector perspective. A portfolio for the long haul should use an anchor as dividend growth, great balance sheet companies, high quality, good brands that have the flexibility to remake themselves because they have significant cash on hand, they have high barriers to entry, and they move forward with whatever cycle we're going into. Have a US bias relative to the rest of the world, despite the fact that international investing is reflationary in nature, or traditionally reflationary. Use your anchor in your studies in terms of the traditional business cycle, but accept unconventional methods. We're in unconventional cycles. We're in modern day business and market cycle times. Don't take the complexity for what it is, break it down, try to make this simpler than it is. Have a rebalancing strategy in your portfolio when you drift too much because of tactical adjustments have all worked. It's really important to rebalance your portfolio down. Don't get greedy, stay balanced, be smart, be prepared. Thanks very much, Steve.
Great, thanks, Chris. And everybody that's on the thing, we're gonna be a test tomorrow on all those topics. So start studying. And I'm gonna throw it out to Addie. Addie, do you want to start taking questions from the audience?
Hi, yeah. Hi, sorry, can you hear me? Yes, we're gonna start taking questions from the audience. So for those of you who have joined via Zoom, feel free to put your questions into the chat and we'll ask those as well. But if anyone in the room has a question, if you want to just come up and you can speak into the laptop and you can ask your question. We can get started with that right now.
All right, Nick.
You're on mute.
Hi, Chris. Thanks for doing this again. I look forward to this every semester. My name's Nick Catrona. I'm the energy sector PM here for the Wildcat Fund. So I kind of have two questions. So as we see these extremely high natural gas prices, especially in Europe and China, do you think, as far as the United States energy industry as a whole, do we think that exports are going to drive domestic natural gas prices up? And I was wondering if you could shed light on what you think price targets for crude and natural gas are for the winter. And then sort of a follow-up, as we see, these shortages because of infrastructure for natural gas and oil, do you think that accelerates the energy transition, especially with renewable diesel and other renewable fuels and clean energy?
Yeah, Nick, good to have you again. You've seen what's going on since you're covering the energy sector. You threw a ton at me. You threw a lot at me. I appreciate you doing that out of the gates. When I meet with clients and I do talks like this, I usually have 3 drinks in front of me. I don't recommend any of you do this. There's a beer, there's a glass of wine, and there's something a little harsher. Your 3 question there is a little harsher. I used to have to take a sip of that. So anyway, with that as the backdrop, there's so much in there. So first and foremost, the biggest issue is Europe and the UK, as you know, $20 to $25 per MCF, in gas prices versus 5 or so here. versus 100 to 150 in Asia. You know, we control the cycle. We control the trade. We control the industry of gas, both LNG, regular natural gas, compressed gas, and even the gas that's used in hospitals, et cetera. So we're a little bit more, what I would say, in control of what the price is going to do, even if it continues to go up there. But it's headed higher. We're heading into the winter season, and we don't have enough renewables or greener technologies yet to make up for the aggregate level of jump up demand that we're still going to witness. At the same time, we're going to have a third reopening. So you've got the Midwestern states, the Western states, Southeastern states are going to exhibit a demand curve that's going to go up for manufacturing reasons, goods purchases, travel, leisure, entertainment, all that stuff. The Northeast is going to go up because of home heating oil and other things. So it's a double whammy. So a little bit of hope here is that it's not as cold in the Northeast. And honestly speaking, that will help. So weather is one, because the aggregate demand curve is still going higher. It's not going down, it's going higher. It's going to remain to be seen how much we're going to export. There's a lot of talk about playing hardball. I don't know if you've seen the political dynamics recently, but the Biden administration has been accused, take your own conclusion from this, but has been accused of not being as strong of an alliance with the Europeans as it relates to moving military to doing military exercises with Australia, not telling anybody, things like that. And they basically threw the ball over into the transom of the Biden administration. So what the Biden administration did recently is says, okay, well, maybe you don't get our gas. So you're going to see a lot of that, but those are shenanigans in political theater. But you mentioned prices. I think you're going to see 20% higher in WTI as a central tendency. I think there's real risk, though, to go to 90 to 100. There's real risk there. That's the risk for 22. You get that, higher interest rates and slower China. The yield curve is going to tell us that. So watch the yield curve, watch spreads as oil continues to head higher. I think energy equities, obviously the big integrateds, you probably know this, Nick, but those are dividend anchors. They should be fine, those dividends, but those are, the big integrators are, you don't buy them for their growth, right? You buy them for their dividends and much higher than bond yields. The gas companies, they're having trouble getting supply, even in the United States right now. Remember the days that we used to burn off excess supply in the New Jersey Turnpike? And for those who live around New Jersey, you see, the flames going up all the time. Well, that's not there. That's not, we didn't have the ability to hold gas before. Now we're looking to take gas out of the ground. Unfortunately, it takes a little bit longer. Equipment's not there. So gas prices are going up. And at the pump and regular gas. I mentioned home heating oil. Jet fuel is going to go up, and we're on the front side of this, not on the back side. So I would take advantage of it through, energy exposure in a portfolio, because it's just getting its second leg to it. In terms of fast tracking renewables and stuff like that, I actually think it's the opposite, Nick. I actually think the realization is going to take hold that superseding hydrocarbons is going to happen over 20 to 30 years, not 5. 70% of the world still gets their primary energy sources of hydrocarbons. So we can't walk away from it as fast as everybody wants, even though we need to over time.
Thank you.
Thanks.
Hi, Chris. Thank you again for doing this. So you spoke in April about you had 3 wedges, the short-term, medium-term, and long-term, and your long-term wedge was regarding inflation. I'm one of the tech portfolio managers covering semis, so I'm curious I forgot to mention at the beginning. I'm curious what you think about inflation going forward, and with regards to achieving full employment. You mentioned that the Fed is going to be focused on asset price stability, among other things, one of those being achieving full employment again. What do you see as key drivers to getting there? Is that going to be um, wage inflation because people are going to realize that, there's no more stimulus coming in and they have to get a job now in order to afford the higher cost goods that they need to live. I'm curious and more thoughts on inflation if you have any. Thank you.
Yeah, sure. So great question because of the sector that you look after. Short term, the wedge is this short term wedge right now is a backup in bond yields, harming high beta, long duration stocks, namely of which is technology growth. The big slice of technology that is most harmed, this, is the big story little profit companies. The ones who don't have enough free cash flow are more of a promise of future cash flows. And as discount rates go up, you discount that value down, right? So fund managers know this. They look at their blotter, and if there's real conviction that yields are going up, every chance they get to remove some exposure from those areas, they do it. And then the model managers and the systematic traders and the algos kick in, and then it gets exacerbated on a daily basis. So that's not going away. That we'll still see that. I do think there's going to be some opportunity in the big mega tech names that actually are cycle agnostic, frankly. They have a lot of free cash flow. They don't care where bond yields go. They can issue debt at any cost, and they're flush with cash, and they're the monsters. So I wouldn't walk away from those. In terms of unemployment and inflation, the first thing to try to remember, a lot of economists do not agree with this, but anytime an economics hat goes on your head, take it right off. Take it right off, because the real economy has a way to fix inflationary forces as long as monetary phenomenons control it. So inflation is not an economics issue. That's price dynamics. Those are things that can fix themselves. For instance, oil prices go too high, it creates inflation. All of a sudden, they get to a level where demand destruction happens, and then they come down. Labor costs, little different. So you need labor supply to control that, to your unemployment question. So let's just dive right into inflation. Inflation is going to remain sticky and higher. For how long? All the way through full employment, and until the fiscal stimulus and monetary stimulus appropriately is removed. How much? I'm going to say it's going to stay in place through 23. And then, because a monetary phenomenon just simply says there's so much dollars out there in the system and velocity is high. If you want to lend, you can lend. If you don't need money, doesn't matter. You're still spending on goods. Prices could be passed on to consumers. Labor costs are going up. But if you take money out of the system, eventually that filters through, inflation rolls over. This is the Fed's problem is they use the word transitory. There's no timeline to transitory. Transitory could be 10 years, it could be 2 years, it could be 1 year, it could be a week. So I think what they should have done, far be it for me to suggest this, but I think what they should have done is said, we recognize there are price pressures in the system. We will use all appropriate tools to address that. And that's it. So I think you're going to see more of that. They're going to say that all the way through until full employment. I think I said the last time, Janet Yellen wrote the book on labor economics. She was a former, she wrote the book on data-driven economics through the reserve-based system based upon employment. And Powell is a credit guy. You put those two dynamics together, you've got balance sheet and labor. So for what it's worth, I don't think you're going to see interest rates go up until we reach full employment. What's full employment? Probably below 4%. You can get there by the third quarter of next year if you run the numbers, which is why many people believe that the dot plots are correct in suggesting a bump up to short-term interest rates late 22. So that's the way I would look at it. How does unemployment fix itself in the short term? Frankly, many people are afraid to come back into the workforce because of home dynamics. Either kids are unvaccinated, they're a little bit fearful through the Delta variant, bringing it home. There's women in the labor force obviously has picked up dramatically. staying home with the kids is something that's more important for them right now. But there's also the dynamic in the lower income cohort where they have received significant stimulus, and the unemployment benefits were just rolling off in September. We think that lag is going to take us, particularly in restaurants, in manufacturing, and construction. We think that takes us into the first quarter of next year. So expect bumpiness in the labor market between now and year end, but then start to take off and average 6, 7, 800,000 again pretty quickly.
Wonderful. Thank you very much.
Sure.
Great. Our next question is coming in through the Q&A function from Matthew Dispenza. He says, thank you for being here today. Warby Parker went public today through a direct listing. Can you explain why Warby Parker might have chosen to go public this way instead of a traditional IPO?
Most people that use direct listings, in some cases SPACs as well, they do it because they don't have the legacy history of financial dynamics, and they don't believe they have the ability for so-called roadshows to take place in traditional IPOs. So they go a direct listing route. A lot of people are suggesting this might be, I don't know the answer to this, more of a fiduciary way to do a listing. I think it's unclear at this point. I expect more of these direct listings because more venture capital companies that want to come public that don't have the financial strength, if you will, or the history that would be most used in a roadshow, they would rather do a direct listing and come to more of a harmonized direct listing a number when they first started to trade. So that's probably why they did it. I didn't look at the press conference, but I suspect that that's one. There's another one that did it recently as well. It starts with an A, I think it's Altamid or something like that, more on the tech side. That was their reasoning, but most people do it because of that.
Awesome. Great. Thanks, Chris. Our next question is here in the room, so I'll turn it over to Matt.
Hey, Chris. So I'm in the material sector, and I was just kind of curious, as we've seen business cycles kind of shorten in length over the last several decades. Do you think this influx of cash is going to accelerate that for at least this business cycle, or how do you kind of view that for this unique situation?
Yeah, no question about it. Great question. Business cycles are getting shorter, but they're also recycling. It's something I didn't mention at the outset. Cycles are recycling in and of themselves. It's like a slinky. I know most of you guys don't know what a slinky is. Steve's probably laughing, but you put a slinky down, as long as it's going downhill, it has the ability to feed on itself, and it just continues to roll down in a coordinated way. In this case, you get a slinky that comes down, rolls back, goes forward, rolls back, and it's because, frankly, of central bank policy around the world. Every time there is a monetary tightening and the economy exhibits a slowdown, they reignite the acceleration, and which is why you don't get long-term business cycle dynamics like you used to. You get a recycling. So to your point about the material sector, small part of the S&P, I don't know, I think it's less than 3%. So is energy. A little bit of money goes a long way in that sector. And I believe that materially based equities, so equities in the material area versus physical commodities, is a much more effective investment than the physical commodity itself. The financial market, futures market, overwhelms the physical commodity market. But as it relates to a material company, if you go through an aggregate demand curve like we're going through with the supply shock, that's where the material sector has their day in the sun. Doesn't last long though, but it takes very little money to double the sector. So it's one of the reasons why we're overweight materials, at least our view at the Chief Investment Office.
Thanks. Yeah, we're overweight too, so good to hear.
Nice.
Oh, sorry. Our next question is coming from in the room. You all set?
Hi, Chris. Thank you for doing this. I just wanted to ask, what's your opinion on cryptocurrencies as we've seen like the exponential rise of decentralized finance since January? And if you believe that both Bitcoin and DeFi are becoming a hedge against inflation.
Yeah, I'm not familiar with cryptocurrencies. What are they? I'm just kidding. So, I mean, I have a lot of thoughts on it. I like to kind of take the chicken way out, if you will, which is I believe the technology is amazing. I believe there's multiple uses of the ecosystem of decentralized finance. I think the biggest use is it cuts down fees. It creates a more secure environment, and it connects two parties together much quicker. I think that is done through appropriate means through blockchain for sure. And then it can go too far, right? You can create any type of exchange mechanism you want and call it a currency, but until it's backed, it's really not a currency. It's a way to express speculation, and that's fine, but you got to know what that means, right? Each cryptocurrency not backed by a traditional asset or an asset base, and certainly not in the banking system, is technically just a speculative asset at this juncture. And it's separate than decentralized finance, in my opinion. I think it's part of it, but it's separate and distinct until it becomes a part of the system. I think you're going to see central bank digital currencies very soon, very quickly, but they will be backed by the fiat currency. So it'll be very different. You know, things like Bitcoin and less so with Ether or Ethereum, and less so some of the more contractual cryptocurrencies. Bitcoin is originally was used to rival gold as a hedge on inflation. Then it was used to for potential nefarious activities, right? I don't think it's a good hedge. This is just my opinion. And the reason is because it has a negative correlation with yields right now. It has a high correlation with the NASDAQ 100. So to me, that is telling us it's a speculative asset versus a hedge on inflation. That could change, but at least that's what it's telling us right now. I have no issue if an institution says they have a little bit of an exposure to it because it's part of their speculative portfolio. But I always say this, know what you're getting into, understand it's speculation. As it relates to the technology though, it is absolutely here to stay. It is going to be more obtrusive, and it will certainly be regulated. That's where we're headed.
Thank you.
Sure.
Perfect. All right, our next question is also coming from within the room.
Hi, Chris. I'm Sean. I'm a sophomore, and my question was about Fed Chair Jerome Powell's renomination to the Fed. So, like, as you probably heard, Elizabeth Warren came out yesterday and said that she strongly opposed his renomination. I was wondering if you think that there's any chance that that sentiment spreads among the progressive contingent of the Senate, as well as maybe like some Republicans that are concerned about inflation and Powell's performance recently as a Fed chair.
Yeah, Sean, great question. It's political theater at its best. Obviously, only the president could renominate the acting Fed chair. President Biden's going to have some pressure on him from a variety of different factions, one of which you mentioned. I do think it's going to grow. I do think you're going to hear more about it. Will it grow in earnest? I'm not sure. And I say that because Fed Chair Powell didn't create a pandemic. Fed Chair Powell created a response to a natural disaster that's second to none. And for certain factions to use that as a way to suggest that he is being overly aggressive, I'm not sure what they're looking at. So for what it's worth, I think you're going to hear a lot of noise about this. I think it grows. Ultimately, I do think he's renominated. I think he should be renominated, not going to back away from that. But nonetheless, there's going to be political jockeying that goes on to try to induce other parts of what they're looking for to come through while they continue to suggest that he shouldn't be renominated. It's how politics works. It's how you're going to really actually see significant movement between now and the midterm election. And the winds, you think the winds of change are coming already? Just wait, those winds are going to blow a little bit more come the first of the year for the 6-month push towards mid-cycle. So from my perspective, I think you're correct. You're going to see more noise around this. I'm not totally convinced it grows in the Republican factions. I think there's a sliver up there that ultra conservatives that will use it as a way to try to, threaten votes. But I think ultimately Biden knows the work that Chair Powell did. And here's one cynical part. I'm not a cynical person at all, but it's fun to be every once in a while. And it's kind of conspicuous that the whole trading of the two Fed governors comes out just before you start to see talk of renomination. So that screams to me that it's political theater and not totally him not going to be renominated. If he doesn't get renominated, I could tell you this, the markets won't like it.
Thank you.
Great. Our next question is coming through online. So it's from Bryce Kuzman, who asks, I know you mentioned you expect higher than expected earnings for the S&P due to high demand and pricing power, as well as continued positive operating leverage. However, with tighter costs due to supply chain issues and labor costs, as you mentioned, is there any concern this operating leverage will go over as we move further away from the beginning of the business cycle where leverage is historically at its best?
Yeah, that question is the central tendency as to when we shift from mid to late cycle, and then ultimately we go to peak profits. So it's a great question. It's definitely something to watch. The number one thing to watch in the next 12 months is going to be when margins peak. And then see whether or not they're rolling over. Either labor cost, price input costs, or what have you, are getting too heavy and operating leverage is starting to roll over. That typically happens after the Federal Reserve is starting to raise interest rates. So we've got a ways to go before that. There's a little bit of dynamics that are different this time. It's a supply shock that's going on because of COVID and other things. But the margin equation is really important. That's one, particularly if we're going to have higher corporate taxes. Number two, I think it's got some time left in it because CapEx is going up at a double-digit rate. You're going to hear stuff like, you saw it out of Micron, right? Micron talked about they lowered their guidance a little bit. Well, they predominantly feed into computers. What did everybody do in 2020? They bought computers to take home. Traders, people in finance, whomever, to run their business. There was a huge movement up in the PC cycle. So of course, PC demand is going to come down when you start to reopen, but it doesn't mean that the trend is going below where we were pre-pandemic. It's still staying above it. So it's just a reset of guidance. Another reset of guidance is the paint manufacturers. You've seen them. They called it demand destruction. It's not accurate. It's just price inputs for chemicals to produce paint have gotten out of whack. They pulled back, but housing cycle is still moving forward. Another one would be Nike's results. They talked about lowering guidance. That's a supply chain issue. It's not a demand issue. So I still think in some sectors, you're going to see margins narrow because there is an overabundance of labor cost in that area, some of the transportation sector. But as we get closer and closer to the labor supply going up, I think that will lessen itself. And ultimately, you've got demand still heading higher. So we've got another 12 plus months, in my opinion, that we're still in good margin territory. But it's a great question.
Great, thanks, Chris. I'm noticing the time, and I know we did say we go until 7:30. So if you have a stop here, totally fine. But we do have a couple more questions in the room if you have to.
Sure. Yeah, no problem.
All right, our next question is in the room.
Okay. Hi, Mr. Hyzy. Thank you so much for all your insight. I had a question specifically on the materials. sector and how you mentioned that Bank of America is currently overweight, which I'm sure has been great with recent trends in inflation and the weakness of the dollar. But I was wondering if you had any opinion on long-term positioning, given that when the Fed raises rates and the value of the dollar begins to strengthen and the materials inverse relation with the strength of the dollar.
Yeah, great question. No question about it. The material sector, first and foremost, is probably the most cyclical sector there is. It's got a high correlation to the global economy, but it has an even higher correlation to ultimately what they call bad inflation. And bad inflation, the first part of inflation going up is good. You get pricing power. The second, the downsloth of bad inflation is when you start to get peak margins. And ultimately, you get into oversupply. And that's what will take down the material sector. The material sector has high correlation to the cost of capital, too. It's very, very, very durable goods and labor intensive, even though they've spent a ton of money on technology. So that's why it becomes very cyclical. You've got some time, but the material sector gets overvalued pretty quickly because it's so small. So you have to watch valuations, but most importantly, watch free cash flow. When it begins to slow down, valuations are next. And that's when it's time to either go neutral or underweight. We've got a little bit, we got about 2 or maybe 3 quarters left before I would call it to the point where it needs further examination. We're still on the front side. We're still on the front side, but it's a great question. And for what it's worth, it's the most cyclical. So higher rates, higher labor costs, ultimately feed into inability to pass on the pricing power at some point. We have excess savings, so you can pass it on right now, but it doesn't last forever.
Okay, great. Thank you so much.
Sure.
Awesome. Thank you again, Chris, for taking the time to speak with us today. I'm like a portfolio manager for the healthcare fund. I know we have a lot of other folks in here that are involved in the wildcat fund or just like personal investing. And as you went through your conversation, you spoke a lot about the sectors that you are bullish on, whether that's financials, energy, some of these. Once you kind of establish that macro outlook, what sectors you're interested in, how do you go about picking individual companies within the sector that you think are very poised to benefit from those macro headwinds or tailwinds?
Yeah, we use a variety of methods. Our portfolio management team that manages the individual equity portfolios outside of the ETFs. On the quantitative side, they use a lot of factor scoring. I personally believe, we call it quantamental. A lot of people use that term, which is half quantitative, half qualitative. I think ultimately our research team is responsible for mixing with the quantitative team to come up with a list of securities that we believe are anchors to a portfolio. We use things like tracking error based upon the index. I'm a big believer in being consistently good, not occasionally great. So it's a mix of quantitative and qualitative factors. I ultimately believe that you have a bulletproof balance sheet. You're not going to grow as much as a higher beta, higher momentum. So the scoring for earnings momentum is really important. This market, this cycle, this equity dynamics that's been around for quite some time gives a high score to earnings momentum. And it gives a very, very, very poor score to bad balance sheets that don't have it. So we rank those factors pretty aggressively. And this is very different than prior cycles. Prior cycles cared more, frankly, about earnings volatility. The less volatility, the better. That is true to a certain extent, but what's really being paid for up in the market is earnings momentum. So we have it at the top of the list. So that's how we go through each of that. We have a research team just like everybody else. We do rely on internal and external dynamics. Earnings attribution analysis is extremely important, And also understanding the companies that are exhibiting high free cash flow. When this cycle begins to peak out, if you don't have the free cash flow on hand and cost of capital through higher interest rates is going up, you will be revalued down pretty aggressively. So I would make sure that you watch that very closely.